we think that they will be forced to take their inflation rates down if they want to invite the consumer back into buying products and services. So we think that this will resolve to the downside.
Hey guys, welcome back to Everyday Finance. In this video, Cathie Wood discusses Bitcoin and crypto. Anyone with an internet connection can now easily establish or purchase an insurance policy. Looking at the form of Bitcoin, it's interesting to note that the volatility it exhibits is quite different from the fluctuations we observe in monetary policy, both in the United States and globally, and lots of things Cathie Wood discusses. So please watch the video to end and share this video and subscribe our channel Everyday Finance. Thanks.
And here you see M2 money supply growth versus CPI. You see money supply, the purple line there, is still negative, but not as negative as it was. That's interesting. You can also see that the CPI is kind of stuck in the 3 to 3.5% rate right now, or at a 3 to 3.5% rate. And what we think is going on right now is that companies are seeing their unit volume growth disappointing. And so they're trying to make it up with pricing. And in doing so, they're actually turning the consumer off more. It's not working. And I'll show you some indicators a little later on to that effect. So we think that they will be forced to take their inflation rates down if they want to invite the consumer back into buying products and services. So we think that this will resolve to the downside. It's been in a range now for, it looks like nearly a year in this 3 to 3.5% range. And if you look at the underlying economy, we're seeing the consumer starting to give way. We've seen it in different ways, housing related, auto related, but now we're talking about restaurants, which certainly have had a strong period as fiscal stimulus was burgeoning, but that's over now. And we do think the inflation rate is going to look a little bit like the money growth rate. We've been saying that we think it will turn negative at some point, and we still do. The biggest lagging indicator in the CPI is rent, and we're seeing signs of rental prices coming down. Actually negative in many parts of the United States. And so that alone will start pulling this down. We're seeing auto prices coming down as well as dealers try and move those units. Tesla's well advertised price cuts, maybe leading the charge, so to speak there. So we think that we do not think inflation is going to stay at this level. We think it is going to resolve to the downside in the next few months. And then here is the yield curve. We focus on this because it typically, when it's below zero, this line, it means that 10-year Treasury yields are below 2-year Treasury yields. And that is still the case. It's usually a harbinger of recession or much lower than expected prices. And I've focused us on this yield curve. If you look at 0809, where it peaked, it looks like it's been on a constant downtrend from a trend point of view in hindsight. And I do think that is saying something about the deflationary undercurrents in the global economy, and that they will continue to build I know that everyone's focused on inflation, but we're going to show you some charts that would suggest that that is not the risk. So this has not changed. And the idea that we're going to have a soft landing, which is the consensus view right now, this chart would argue against it. In fact, you can see, except for the 80s, every time it has been at this level, we have ended up in a recession, which you can see by the shaded lines. It took more of an inverted yield curve to get a recession going in the 80s, but every time since, we've pretty much had a recession every time the yield curve has been around this level. And we've been talking about a rolling recession, housing, autos. We'll get into that more. Now we're seeing more capitulation more broadly from consumers. Here's the real Fed funds rate. So the Fed funds rate is roughly 5.5%, and 5 to 5.5%. And you can see the minus 3% gets us to 2.5% there.
An inactive Bitcoin address from the past has recently become active after a decade of dormancy. A Bitcoin wallet with 687 BTC, worth $4.43 million, recently made a transfer to 2 different wallets on May 6th. The first transfer was of 602.43 BTC to an address, starting with the 1 key, while the remaining 61.9 BTC was sent to Guanketu. It's interesting to note the movement of funds from older wallets, particularly from the city. The Satoshi era frequently piques the interest of the crypto community. It refers to the initial period following the creation of Bitcoin, during which its enigmatic founder, Satoshi Nakamoto, actively participated in online forums. There is speculation surrounding certain Satoshi-era wallets, suggesting a potential connection to Satoshi himself. Last year in August, a wallet suddenly emerged from dormancy after being inactive for nearly 14 years. It transferred 105 BTC that were mined in 2010. This movement of the wallet generated a lot of attention on social media, with many speculating that it could be Satoshi's wallet. However, experts believe it is more likely linked to early miners or buyers who are simply looking to make a profit. This information is based on a report by Fortune. There are a staggering 1.75 million Bitcoin wallets that have been inactive for over a decade. Many of these wallets hold a substantial amount of BTC, which was likely purchased when the price was in the double digits. These holdings are now worth millions. These Doran wallets hold a staggering amount of 1,078,681 Bitcoin, which currently have a value of approximately $121 billion. This impressive growth has occurred over the past few years. Several wallets associated with Satoshi AOW have recently become active, transferring their BTC holdings to new addresses. Some of these wallets have also moved their BTC holdings to crypto exchanges, indicating a potential desire to cash out after nearly a decade. In July 2023, a wallet that had been inactive for 11 years transferred $30 million worth of BTC. Then, in November, 3 Satoshi-era BTC wallets moved $230 million worth of BTC, after being dormant for 6 years. These 3 wallets are believed to be connected to the same individual or organization, as their last transaction was made on November 5, 2017. Let's get back to Cathie Wood interview.
If inflation does come down the way we expect and the Fed does not cut rates, which the markets now don't expect one until November, if they don't cut as inflation's coming down, then this line is going to go out closer to 5%. Again, we haven't seen that really since the 80s, when inflation was still considered embedded or at risk of going back to double digits. We're nothing like that today. On the next page, this slide is how long the Fed has kept interest rates higher for longer, meaning the length of time from its last rate hike to the first cut. And you can see we're above average now. And you can also see the last 3 times this happened, when we were higher than even we are now, was a harbinger of the 0809 global financial crisis. So that was 0607. It was a harbinger of the tech and telecom bust in 97, 98. And in 1969-70, it was the harbinger of a recession, and the closing of the gold window as well. So they haven't been great periods, or at least harbingers of great periods. So we are taking due note. So just a quick note on fiscal policy. You can see the deficit. We present this each time, and just want to reinforce that the antidote to this deficit, which in a so-called expansion is at 6.5%, that really has not happened except in the aftermath of the 0809 meltdown, while stimulus was still flowing freely in response to it. But we're not in such a meltdown now, and we do believe growth is going to be the solution, as it was in the 90s. You can see the 90s in the Clinton administration for the most part. We ended up back in a surplus, which was a function of the very good growth. And I'll mention that the internet really started to take off in the early 90s, and that was a big part of that decade of growth. And we think the ChatGPT moment is very similar to what happened in 1993, which was the first time that email was connected to the internet. It was a big aha moment, just like ChatGPT was for artificial intelligence. And we think AI is going to be a huge catalyst and is going to stimulate and accelerate the growth in our other innovation platforms, which are robotics, energy storage, blockchain technology, and multi-omic sequencing in the life science space. All of those are getting ready to deliver massive growth rates that will really move the needle in terms of GDP. Unlike the aftermath of the tech and telecom bubble, the technologies, the internet was going, and the growth was very good, but some of the expectations, like personalized medicine, we were not near that at all. We are now. And so we think that this federal deficit, if there's any discipline whatsoever in terms of spending.
Bitcoin kicks off the week with a renewed sense of optimism as $644,000 makes a triumphant return. The BTC price has successfully surpassed its recent swing lows, surging by almost $8,000 compared to last week's sell-off. It's worth noting that some of these gains were achieved over the weekend, indicating their resilience. And during the May 6th Asia trading session, bears are struggling to push the market back down. The mood is noticeably different in the second week of May, with greed starting to become more apparent. Bitcoin. With altcoins in the mix, the focus now shifts to whether sustainable momentum can be maintained towards all-time highs. Traders and analysts are pondering this question after experiencing a dip in prices and a significant reduction in leverage on exchanges. Despite these challenges, the outlook remains promising, with funding rates currently in a neutral position. There is a lack of widespread interest in buying BTC at its current levels, indicating caution among investors. However, if the situation worsens, it will be crucial to see how key support levels hold up. These levels include the short-term holder's cost basis and the 100-day moving average, which are commonly seen as levels where prices could potentially rebound. If you learned something from this video, then please like this video and subscribe our channel Everyday Finance, and we will meet in next video. Thanks.